Hey traders, welcome to Charts and Coffee. Happy Monday, everybody. Hope everyone is doing well. We've got an interesting week coming up. I've got a few of the hot zones that are on tap for this week. We've got a bunch of Fed speak today. So if you haven't checked out the economic calendar, a really easy one to use just to stay on top of all the data that's going to be bombarding us on any given day would be something like Forex Factory, trading economics, and you'll see that we have FOMC Bostic and Barr this afternoon. And then at some point, tentatively, there's a presidential press conference with the governor of Louisiana, I believe. But the bigger narratives are going to be on Thursday. We've got final GDP. Is GDP as important a number as it's been in the past? I'd say likely not. It's not as big a deal because whether or not we're in a recession really has less to do with the classic definition of sequential negative GDP quarters. And now it's really more about the precursor, the headlines, the psychology around it, because that's ultimately what's going to sway traders and investors into believing we have a recession. And GDP's really sole reason for being at this point has been reduced to sort of this recession indicator. So it's probably the least I've ever seen in my 30 plus years paid attention to. However, the final version is Thursday. Now, let's talk about numbers that are a big deal and are going to have a massive macroeconomic impact. Core PCE. So within the hallowed halls of the Federal Reserve, there are all these models that they're using. These economists are crunching numbers. What numbers do they use? Are they using CPI to say, hey, inflation's going up or down? They are not. Are they using, different PMI numbers? No, for the most part, the models are largely dependent on the PCE, which is calculated in a markedly different way than the CPI. They're both inflation metrics, but what kind of weighting do you give to all the goods and services? What kind of weighting do you give to one sector or another? And PCE, if you want a good laugh, you can ask. I'm a big Perplexity fan. You can ask Perplexity, hey, Perplexity, give me the top 5 differences between core PCE and core CPI, and you'll see the differences in the calculation. Nonetheless, here's the most important thing. The one that the Federal Reserve uses is the PCE. Therefore, the one that we need to pay attention to as traders and investors is the one that they're using to make their messaging shifts and obviously their policy shifts. Are we likely to still see rate cuts this year? Core PCE obviously can have a big impact on that. But even before that comes out, what is the likelihood of seeing more rate cuts this year? I know there's always a lot of speculation about it, but we don't have to guess. We don't have to say, we don't know, or how could the Fed do this, or how could they not do that? That's really missing the point as far as what our job is as traders. My job is not to second guess, maybe make fun of a little bit, but my job is not to second guess why they're doing what they're doing. I am not a voter, right? I have no control of what they're going to do. My job is to react. So it's really interesting when I look at conversations around the Federal Reserve and folks want to make commentary on what they're doing. And, look, I don't get paid to make commentary on that. That's never the point. What are they going to do and when are they going to do it? That's how we as traders make better decisions and ultimately get paid. And so be careful delving into the Fed has no idea what they're doing. Doesn't matter. It only matters what they're doing. And if they need to shift policy, they will do so with their words before they do so in the actual meetings. And right now, it is 88% certain they will do nothing in the next meeting. And you might say, Rob, what are you looking at? Why do you trust it? Well, why do we trust gold futures prices? Why do we trust crude oil prices? Heck, why are we looking at the S&P? Why are we looking at S&P futures? For the same reason I would look at Fed fund futures. Its job is to measure expectations, not just now, but future expectations around what the monetary policy rate is ultimately going to be, or the target rate probability. What is the rate expected to be after the decision? So that would show us that the rate cuts are not in any way meaningfully priced in until June. And they're 100%, I shouldn't say 100%, but it is far more likely that if we don't cut in June, we'll cut in July, or that we will cut in June and July. Now, along the way, we have the stepping stones of data. If the data suggests inflation is cooler, if the data suggests employment's being affected negatively, or that the retail activity is lower, that home sales are lower, that's going to just continue to push on the Federal Reserve's likelihood of cutting rates. And here's why we care about any of this. Rog, why do you care about this? Well, the only macro that matters is Jerome and Company. And macro in terms of rates, how accommodative a rate's going to be. Well, if rates go lower, what are the ripple effects, right? And they're typically positive to the stock market. You might say, what's happening now, Rog? Well, this is very much, if we look back on the first 100 days of any new administration, there is volatility, period, right? Might there be more now? Sure, absolutely. But again, let's go back to what I mentioned earlier, things that, frankly, losing traders do, things that traders do when they forget their job is not to pretend to be a television analyst and rather to manage risk. Ultimately, we just react to what's there, right? There's a prediction psychology that's really infected, and I use that word specifically, that's really infected traders' thinking. They think their job is to pick the top, pick the bottom. That's not really ever been our job historically. It's just become much more popular, frankly, since it was so celebrated in The Big Short, right? That was celebrated, and everyone has these dreams of, their inner Michael Burry calling a top or a bottom in a market. We celebrate those things on television. Television, of course, is meant to entertain, as are movies. So let's go back to the world we live in. Think about June, July as when the rates will be cut. That means it's this prolonged pause. In the meantime, we're not getting lower rates. And in the meantime, we have all sorts of economic uncertainty around new policy shifts, period, right? Anything more than that just gets into emotion, gets into bias, and takes us further away from, frankly, making money. At the end of the day, if we go all the way out to December, yes, it is widely anticipated we will be anywhere from at least 2 cuts lower than we are right now on March 24 to up to 4 cuts. I'd say 4 is pushing it, 2 to 3 is most likely, and I will just study the data, period, right? And we also know, although it doesn't seem to be celebrated as much, we really love traders like Jim Simons, right? Why do we love that guy? Because he followed the data. And something deep inside of us knows that discipline to process, that discipline to the data is something we all want to be. And then we get kind of taken into Emotionville and we lose that track to following the data, testing a process, and rinse and repeat, regardless of whatever the talking heads have to say. It's a very tempting thing, right? They know what they're doing, right? Don't for a second underestimate how good the folks are at stealing our attention, right? They're very good at it because their advertisers expect them to, so they can get paid. And, when I look at the conversations over the weekend, I'll go into Reddit and I'll go on to X and I'll go take a look at the different blog posts, and all I see is emotion, emotion, emotion. Trade what we see, not what we think, right? And this is the data. So if ever you're losing your bearings, here's the easiest thing. Shut it off. Shut it off. Go back to your process. And if you're thinking, Rog, gosh, this sounds good. I don't have a process. No problem. Find someone who's been doing it for decades. I don't mean the last 3 or 4 years, right? Go find someone who's been doing this for decades. Maybe it's me, maybe it's somebody else. Find somebody who's been doing this for a long time and can say, you know what? I've been here before, and this is how we dealt with it. And believe me, gang, almost every time is an iteration of something we've seen before. Very rarely is something completely new. We've seen hedge fund implosions. We've seen bubbles burst. The details might be different. The scale, obviously. People say, Rog, it's so much more volatile now. Well, go back to 2001 and look at the tech bubble bursting. And then take a look, not at how much it sold off, but how much the index was worth at the time, right? So if price movement is a percentage of the value of the thing, right? 10% of 10 is very different than 10% of 1,000. It's still 10%, but the price movement's going to be different. So yeah, everything does have, just even from a price perspective, a lot more volatility because we're talking about, look, the NASDAQ was trading around 5,000, right back then. If you're thinking, oh my gosh, everyone's saying the NASDAQ rolled over from 5 and went down to, what was it, 1,700 or whatever the number is. It's at 20,000 now, right? It's 4 times bigger. So yes, everything looks on the chart to be more volatile. So just remember, someone out there has been through some iteration of what we're doing right now. And the biggest shortcut to any success is go find someone who's done it and then model their behavior, go model their strategy, go model the approach. And that's always been my theory. My models happen to have been, funny enough, folks who traded in the early 1900s. I love those ancient trading things. I love reading things that Charles Dow, that Dow, wrote about the market. And I think, gosh, this was before algos and computers and high frequency. And yet we as humans have changed almost none. And that's the cool part of it. It doesn't matter what the new, dark at the top of the stairs and monster under the bed is. We've seen some iteration of this before. All right. That being said, let's see. Questions. And like I said, if you're looking for a process, if you're looking for someone to model, come check out what we're doing in the Sector Secrets Mastery. All right. What are my thoughts on Amazon? Tons. That's a lot to unwrap. And I appreciate your frankness and everything. So this is going to sound a little bit like salt in a wound, but I hope that then this becomes a really important pivot point for you. And anyone listening who's in a similar boat, right? We've all been here. First of all, when you buy something at 225, I have no idea why you did, right? So I can't go back and say, why was 225 a buy? So let's just go down to what was the stop loss? Let's go to basics. I was just watching The Last Dance over the weekend. And does everyone, I actually have that picture on my wall. Do I remember that last shot when Jordan was exhausted? They were playing the Jazz and he talks about 1, 2, 3, point the fingers, right? Point the fingers at the net. He was so exhausted. He went right back to the fundamentals that he probably learned in high school, that he probably learned in North Carolina when he was in college. So he went back to basics. So let's do that, right? 1, 2, 3, point the fingers at the net. 1, why that entry? All right. So that could differ for strategy, and that's fine. That's probably the least important part of our conversation. Number 2 is, at what point do you know you're wrong? All right? And then how do you protect yourself in the event that the theory, the reason for buying at 225 is no longer valid? And I like using the word no longer valid. I actually don't like the word stop loss, because stop loss are negotiable. Where is a trade no longer valid? In my mind, and golly, gang, believe me, I'm thick-headed, I'm stubborn, I'm impatient, I'm all those things, but process saves me from me. So where is a trade no longer valid? Okay, cool. And then, there's some more things underneath that I teach in the mastery, like, what would be the negative impact to the account? All right. So then the next thing is, notice I start with exits, then entry, right? Or exits, then, what the potential target is, stop, risk over profit. So the next thing is, where would price have to go in order for you to pay yourself, right? I don't know which time, 225 was bought. Was it 225 to 240 and change? In which case you probably had a pretty good trade on your hands. If it was 225 and then it sunk, you haven't had much chance. But just again, supposing whichever version of a 225 buy you had. And that's really, right? That's really it. Never, and I see this all the time. And gang, look, I'm not going to go naming names, but I watch it all the time. Somebody buys at this level, they buy again at this level, and they buy again at this level, and they'll just keep buying it on the way down. And it's under the guise of this all being strategy. I'm not a big fan of adding to losers, and I'm not a big fan of holding on to losers. It's a whole lot easier to come back from a paper cut than it is to lose a finger. That's our theory in the Sector Secrets Mastery. If I can take smaller losses, even if I take them more often than I frankly want to, if I can take smaller losses, I can come back from a small loss. But bigger losses not only have a percentage impact of my account that's harder to come back from, psychologically, it's harder to come back from. So now you take a big loss and you're sort of standing there taking an 8 count because the markets have just rocked you. And now you're supposed to say, I'm supposed to bring my best self, confident self forward and dig myself out of this hole. And I just don't believe most humans are wired that way. I know I'm not. right? I know a big loss is going to shake me far more than the tangible money that, leaves my account, or better put, someone took that out of my account. So I like a competitive view of trading. I just don't want to say, oh, I lost. No, someone took it from me. Most of us will do more to prevent something being taken than simply losing it. So I try to put all the psychology in. Hey, somebody out there is preparing to take my money. Let me make sure I'm protecting myself. Let me make sure that I'm doing what I need to do to be right. So if I look at it from a competitive perspective, I bring a better plan forward. And that's another trick that I use for my own mind. So that's the way I would look at it. There's nothing I can tell you right now as far as whether it's going to come back or not. Now, you own the shares. That's one really good thing for you. If you own the shares and you own them outright, they're yours, right? Is Amazon most likely to come back? I'm not going to say yes, and I'm not going to say when, but let's face it, if given enough time, right? And I don't know if this brings you any solace, and that's not the point here, but if someone said, Rog, now you're looking at a weekly chart, regardless of where you got in. I mean, hopefully that, the purchase wasn't, too high, although look at the price that it topped out at. Please don't be up there, right? Don't buy into new highs. But if someone were to say, if given enough time, what do you think the direction of Amazon is? So because you have the shares and not the option, you don't have that terrible position of owning a depreciating asset, right? You've got the shares. They're yours, I'm presuming. Again, just the way I would look at it for my own self, if I made an error in tactics or whatnot, and I'm sitting here going, well, what do I do now? Chances are does anyone here think Amazon's going out of business? Does anyone here think Amazon's not going to at some point resume the uptrend? Does anyone here not think the NASDAQ at some point will resume the uptrend? All right, it's far easier to be a bull given a longer span of time. That's what made Warren Buffett a billionaire. Warren Buffett never comes out and says the economy is in a disaster and he never talks like that. He never talks like that. And he's the richest, one of the best longer-term investors ever, right? Because he keeps risk management, but he has a general belief that stocks drift higher. And I believe that too. So take from that what you will. That's the way I would look at any position like that. All right. So again, I'm not talking about an ideal scenario. We're trying to make lemonade from lemons, but as a general rule, stocks do drift higher. I think go back to what we mentioned earlier. What was my stop? Don't believe it's going to come back immediately. The saving grace was you own the shares and not an option, in which case, obviously, the option's likely to expire, lose value in the meantime, and that's a whole different scenario. All right. Let's see here. And thank you for the question, because I think for a lot of traders, the joke is, what's an investment? It's a trade gone bad. And that's all too often the case. But in this situation, you'll probably see a natural drift. All right. Ren says, do I have any guidance on setting upside targets? I never, ever, ever, and I see this all the time too, looking for 50% return, 100% return. That's completely make-believe. That's tooth fairy trading. Oh, the tooth fairy's going to come and put money under my pillow, which also requires, getting one of your teeth knocked out. So the way I look at it is, what's a target? What's another word for a target, Ren? If I were to find a synonym for target, let's say we're long or short, but what's another synonym for a target? For me, it's obstacle. What's the obstacle to price continuing to move higher? What's in the way? What's the brick wall? What's the closed door in the way? Rather than presume I'm going to be able to bust through the wall, right, and leave a Raghee-shaped hole in the wall, I'm going to take a little bit of profit and then see if there's enough momentum to break. So I'll be very proactive about paying myself. And I look at my tools and ask myself whether it's volume volatility, whether it's a Darvis, whatever it is. Maybe it's an all-time high. What's the obstacle along the way of progress in the trade? And that's why I like to scale out as a trade's going in my favor, not presuming I'm going to pick the high. All right. And again, these are not tactical only differences. They're really philosophical differences. For some traders, their target is 100%. Well, what if you reach an obstacle at 80? Is that not good enough? And a lot of those are ego targets, right? What's an ego number? Win rate. Win rate without a discussion about average winning size and average losing size, which frankly nobody does, right? When I do a webinar, We talk about that because all the metrics matter, right? So win rate is a vanity metric without the discussion of average loss and average win. What's another vanity metric? 100% return, right? I love when I get that, but that simply means the obstacle didn't prevent the trade from growing in that direction, right? So a lot of trading does boil down to tactics, obviously, and then after that, it's the tactics of, am I looking at what I'm trading, or am I just trying to trade around some vanity metric that I need to be able to hang my hat on? It's an interesting game we play, gang. I like to say that trading is self-discovery disguised as candlesticks. All right, gang, be good to each other. I will talk to you tomorrow, same time, same station.